I'm Nikki. I'm a consultant and educator working at the intersection of sustainability, social impact, and organizational strategy. And I've spent over a decade working with founders and startups trying to help build things to serve purpose and sustain. And that's exactly why I'm so excited about what we're going to see today. And this is the kind of conversation I wish had existed earlier in my own career. And I'm here to set the scene and then hand you over to Graham, who is going to show you something really eye-opening. So let me start with something that you probably already know. Only 1 out of 10 startups actually succeed. And we have a whole library of explanations for this. We blame the founder, we blame the team, we blame the wrong hire, the wrong market timing. But what if those reasons really weren't explanation enough? What if underneath all of that, the way we're taught to plan for the future is fundamentally broken? Not broken because of effort, not broken because of vision, broken at the level of the math we use to model what comes next. So let me ask you something, and I want you to drop your answer in the chat. If you keep going long enough, good and bad outcomes average out over time. Is this true or false? I'll give everyone a few moments to put your answer in the chat. So most of us instinctively, perhaps even before saying false, might want to say true, but it is actually false. And that single insight is what this entire webinar is really built on. I want you to picture 2 things. First, a collection of potted plants. Each one has its own pot. You tend to them carefully. You hope at least 1 or 2 grow big enough. But when something goes wrong, a drought, a disease, a frost, each plant faces it alone, and there's nothing to catch it. Now picture a forest. There's different species, different ages, different root systems that are all deeply and invisibly connected. When one tree falls, others fill the gap. When resources run short, the network shares. The forest as a whole is resilient in ways that no single plant could ever be. And the uncomfortable truth is, the way most of us invest in and build startups right now, we're planting potted plants and then hoping for forests. And what Graham has extensively researched and designed using maths is a way to change that by modeling your business the way a forest actually works. So here's the core of it, and I want you to really sit with this for a second. In all complex systems, natural ecosystems, economies, societies, the most typical outcome for most individuals is always less than the average. And what does that mean for your business? It means that calculations and equations economists have been using in business, the ones that assume averages, that smooth out bumps, they're not just optimistic. They're not taking into account real-world dynamics of life. All living systems, including business, is non-ergodic. And the equations currently being used pretend that a startup's path is predictable, and business planning based on this false assumption is not only misleading, it's what's led to a huge amount of waste and extraction in our economy to make up for gaps and losses in this assumption. And the good news is once we see this clearly, we can do something about it. So here's what today is designed to give you. By the time we're done, you'll have clarity on why the failure rate is what it is and why it's not your fault that the tools haven't shown you this. You'll have a new lens for thinking about your business, one that takes volatility seriously. You'll see a real tool that makes these ideas concrete, and you'll leave with a sense of what you can actually do next. And to get specific for a second, this means course correcting on aspects like diversity, adaptability, and exposure to failure. So we're not here to overwhelm you with theory. We're here to give you a moment of recognition that, oh, this is what's been happening and a direction. So now I'm going to hand it over to Graham.
Thank you, Nikki.
Of course.
So, picking up on what Nikki said before we move into the live simulation that we've developed, um, the heart of almost all of economics, of business school teachings, the heart of modern portfolio theory that investors use, it all has deeply inside it the belief that if you keep going for long enough, all of the randomness will average out. And that what you're left with is then an outcome that is the right outcome based on merit. And we see this also throughout human society that, you know, what matters is how good you are, how good your product market fit is, how good your leadership is, how good your team is. So we'll see in a moment that's not actually true. This is a relatively simple business and portfolio planning app that we are busy developing. We've got it to the point where it really illustrates clearly what Nikki has been introducing, which is the relative role in business success of striking it lucky, striking it unlucky, versus actual merit, the skill of the leadership, the product market fit quality, and all of these other things. So I'll dive straight in and show you, first of all, a simulation of a relatively realistic but simple company. And let's have a look at the results. It takes a few moments for the simulation engine to run. And what you're seeing over here is what comes out of classic business planning. You see over here and here you had investment rounds, and then you have growth. And it looks as, a normal business planning prediction here will say this company after 10 years is going to end up with an 11, almost a 12 million euro cash balance. And so the founders are going to look at this and say, well, this is a brilliant business to invest our time and money into it. Investors are going to say the same thing. Everybody's going to invest. The assumption, as Nikki said, that is hidden inside this way of doing business planning is that all of the fluctuations trend towards the average. In other words, randomness trends towards the average. You just need to keep going long enough and you'll get there. The next part of the simulation looks at single paths that this company might move down. And so this is path number one. You see, this doesn't look anything like the normal business plan that you would get. Path number one, basically the company goes insolvent about a year into operations. What do we call the volatility tax, or the non-ergodic losses, is total loss. So if you compare the two, traditional business planning says that the company is going to end up at 11,690,000. This specific path ends up at a loss. So the gap between what actually happened in this universe and normal business planning is minus 11,691,000. We can try a second path. Again, insolvency around about 18 months in. The third one, that actually looked really good. It was outperforming a bit at the beginning, but then insolvency. Fourth path, insolvent. Fifth path, insolvent. Sixth, insolvent. Seventh, eighth. Only the first time that we actually had this company doing well was the eighth possible universe it might go down. Ninth, insolvent. 10th, 11th, 12th. That one actually looks really good. It ends up slightly higher in performance than the normal business plan goes. So what you're seeing here is exactly the same company, exactly the same leadership team, exactly the same business plan, exactly the same operations team, the same sales team. Everything is the same. There is no difference in merit between any of these paths. The only thing that changes from one path to a next is the randomness, the volatility, the unpredictables. What's completely out of the business's control happens in a different order and maybe a different combination. In other words, the only difference between all 500 of the paths in this volatile single run is how the dice land. There's no difference in anything else. This is just how the dice land. If we look at all 500 paths, instead of looking at the single paths, we look at all 500 together, we get this one. The solid blue line that goes to insolvency about month 39, that is the middle company. In other words, half of the universes are worse than that, half of them are better than that. The light blue is the middle 50%. The slightly darker blue bands over here and over here are 15% each. And the dark blue band over here is the bottom 10% and the top 10%. And so what you're seeing here is that you only have the way that this business is structured and the kind of randomness it's exposed to, the things that are completely out of its control, mean that this business actually only has around a 1 in 10 chance of delivering the business plan forecast the traditional business planning processes predict that the average should be. And this is an example of what Nikki was getting at. The most likely outcome here, which is going to be somewhere in this light blue middle range or the two bands below it, the most likely outcome is insolvency. And you need to actually have a lucky run of the dice for this to work out good. So let me show you what's actually happening inside here. So if I go back, and by the way, you can all head into here and play with this as much as you want. It's at, you'll see over there, planner.evolute6.com, and you can create an account, log in and play with it. Just a caution though, there are a bunch of subtleties inside here that need to be worked through. So if you want to do it seriously as part of your startup planning or portfolio planning, probably best to come to us and have a run through and maybe us guide you through some of the parameters that need to be carefully adjusted by hand at the moment. So what's in here? So first of all, capital structure. This is a company set up with 3 investment rounds. Month 0 on founding is 1 million comes in, then a seed round 6 months down the line of another 500,000, and after 12 months another 500,000 comes in, with no credit facility, no dividends being paid, and operations. There is one revenue stream which is growing at 1% per month on average. Startup costs in the first few months of 200,000 per, but not growing. Operating costs of 100,000, which is growing at 1% per month. And again, phase two setup costs of another 100,000, but that doesn't grow. So that's basically your cash flow is a growing sales, a two fixed sets of startup costs per month for a limited period, and a growing operating cost. With that, and no headcount is defined. There's nothing in here where we're gaining interest. This is what you would set up if you want to model an investment fund. And the other thing I'll point out, swan events, which is black swan or white swan events, we don't have any high impact black swan events or highly lucky white swan events. Those can be built in as well and would model something like COVID. We don't have any of those per company, but we do have those in for all of the companies together. So that's what's going into here. And one of the key messages to take away now, if you compare, let's just stay here for a moment. This is the average growth rate over all of the volatility, over all of the randomness. It's growing at 1% per month, as are the operating costs. They're also growing at 1% per month. So what I showed you in the projections, normal business planning simply takes that average of 1% growth per month and extrapolates that out over the 12-month period. And the key message to take away is that that leads to a significant overestimate of the likely success of the company. Instead, what you really ought to do is calculate 500 or even better, 1,000 equally likely paths that the company might go down, these ones, and look at them, ideally look at all of them on a fan chart. And instead of saying, yeah, I'll found the company or I'll invest in the company, if the business plan based on the average looks good, because that's really a misguiding way of calculating likely outcomes in a world full of randomness. The point is to look at this chart and say, this is only worth investing in if this blue line, the median blue line, is above my minimum target. If it's below, don't invest, because then the typical outcome is where that blue line is. That's the middle of range of the typical outcomes. And what you're seeing here in this particular example, what's called the volatility tax or non-ergodic losses. In other words, the gap between the typical outcome and what normal business planning predicts, that one. That gap in these cases is basically the same size as the average. So you're most likely to lose everything. Your probability of the business surviving 10 years is only 15%. And the median cash position is deeply negative. Yes, the upside, if you get really lucky and you're in that top 10% of luck with the dice over there, then your upside potential is what the normal business plan predicted. So the key message to take away from this is that whilst we think that we're living in a meritocracy, actually we're living in a luckocracy. Luck is a much more significant driver of success than everything that we're taught in business school, university, in, let's say, in Western culture. Luck is a much, much bigger driver of success than we like to think. Equally, bad luck is a much bigger driver of not succeeding than we like to think. So, that's a really important message to take away. both at a personal level and in terms of the startups we found, the investments we make. It means that when we're trying to find why did something succeed so that we can replicate it, or why did something fail so that we can remove the root causes of failure, we need to do a much more thorough investigation of the relative role of randomness, what you're seeing on this chart, versus true meritocratic root causes. In other words, the quality of the leadership, or if you're an investor, the quality of your investment decision process. If you're thinking of yourself, you know, this gives you much more scope to not harmfully blame yourself for things that were actually out of your control. Equally, not be subject to harmful ego inflation because you think that something went right because of you, when actually the dice just landed with a row of sixes for you, but for everybody else, it was ones and twos and threes and fours and fives and sixes in an even balance. So that's one of the key messages to take away. Another key message to take away from this is, there's an old trope in business of luck is not a strategy. Well, what this tells us is it's true that luck is not a strategy. You do need to be good enough. You do need to have a solid product market fit. You do need to work on the team dynamics, minimize the needless conflict in the team. And luck is a really, really significant component of success and failure. And we need to discriminate between how much of our success or failure is actually due to things that are merit-based, that we can influence, where we can get better at it, and how much of it is about luck, which we can't influence, we can't get better at. What we can do with luck, though, is have luck as a strategy. Now, if you look at this plot over here, what you see is that this company, 500 different equally possible evolutions of that company over 10 years. In some of those evolutions, the company got really lucky and it really outperformed even beyond the original prediction. In others, it just did really badly and went insolvent. The strategy to tap into luck is the strategy that nature has proven for 4.7 billion years. It's the strategy that Nikki pointed at with the metaphor of a pot plant versus a forest. A forest is far more anti-fragile than individual pot plants are, because forests are able to pool resources. They're able to collaborate. They have interlocking root systems. The mycelium across the entire forest is interlocking. It means that if one tree has really good luck, it can spread that luck to some of the other trees. If another tree has bad luck, it can be buffered temporarily from the support of the other trees. And if we put this in here, what's called the ergodicity correction, let me take that up to 100% and we see what it does. That will take a little bit of time to run. The ergodicity correction is going to change significantly the look of this fan chart. What you see now, when you put in the ergodicity correction, the middle road is right up here. It's only 60,000 euros lower than the normal business plan plot. About 90.6% probability of survival. So simply by changing from, we build businesses as potted plants with absolutely no connection between them, no possibility of having a strategy for luck, a strategy where the luck of one example of the business benefits all of them, and we can dive more into detail of what that means. This enables you to have a strategy for luck. It's the strategy that forests use rather than the potted plants. I want to show you one more aspect and then move over to some discussion and questions. And so please start popping questions into the chat window if you haven't already. But I'm going to show you two other examples. So this example has high volatility with higher probability of extreme events. And I'm actually going to take away the ergodicity correction first. So we're comparing uncorrected. If I simply change the same company, but I reduce it to medium level of volatility, the company is still most likely to go insolvent around here, but there's a bit more chance that it will do better. There's now a 44% chance of survival, whereas with the high volatility, now in this simulation, there's only a 13% chance of survival. And if I go to really low volatility, you see now there's a 100% chance of survival. The middle company is doing almost as well as the standard business planning. So this is really the core message to take away. If you're starting a business or if you're investing in a business, the standard way of doing business planning or portfolio planning, which assumes that you can take the average and extrapolate it out, cannot tell the difference between this scenario, which has exactly the same average growth rate but low volatility, versus this scenario, which has exactly the same average growth rate but medium volatility, and this scenario, which has exactly the same average but high volatility. Standard business planning approaches, standard investment decision approaches, portfolio planning tools make the mistake of averaging over volatility first and then extrapolating, which completely hides all of the information that you see comparing this graph with that one, with that one. As I said, in each of these three cases, the average growth rate of the company is identical. All that is different is how big is the randomness that the company is exposed to. And that randomness is something that is completely outside anybody's control. You can't control the randomness of the universe. Nobody could, let's say when COVID came in, that was a big random event. And that kind of randomness is included if you do this kind of business planning approach. It's completely missing if you do normal business planning approaches.
What are the variables in your model that represent volatility? From Gabriella Leslie.
Right. So we have some fairly sophisticated stuff inside the model. So for all of the revenue streams, expense streams, also for anything where the capital is being invested, you can choose between one model where you have a flat distribution between a minimum and a maximum and an even spread of choices between that. And so in this extreme, you might say, right, I'm going to have capital growing of either 50% growth or 40% loss. And those are the only two options. So it's a coin toss. One month the coin will land heads and my revenue grows 50%. Another month it might land tails and my revenue drops by 40%. This plus 50 minus 40%, traditional business planning would say, yeah, that's a good business to invest in because the average of plus 50 and minus 40 is plus 5%. But when you actually calculate what this really means on a month by month basis, you see again that the most likely outcome in that situation is that the company goes insolvent after about 5 years. There's a second model which is much more sophisticated that's in here, where again, you can put in the average growth rate and then you can choose, do you have a very narrow distribution with very flat tails? Or do you have a very broad distribution with high tails, in other words, a high likelihood of swan events? You can choose to be a normal Gaussian halfway between, and you can also choose that to be biased one way or the other. In other words, downwardly biased where there's a preference for failure, or upwardly biased if there's a preference for failure there. So that's another randomness model in there. And there's the third possibility you can also choose is students' T distribution. So there's a bunch of other things out there.
Okay, so from Daniel again, okay, maybe to randomness, and there is maybe only one failure in business, that of failing to value relationship correctly. Maybe that's not really a question, but more of a share of a comment, a thought.
Yes. So that has some depth to it that I'll take a bit of time on, which is you're absolutely right. The what I'm pointing at here is let's say a fundamental simplification that economists made 150 years ago in how they modeled the economy, how they thought the real world behaves. What we're now seeing is when you actually look at how randomness actually impacts us in the real world, it's far worse than what is included in economic theory, business planning theory, portfolio theory, etc. And the example I showed you of that ergodicity correction requires the businesses to collaborate with each other. And so the key message there is in a highly random world, we need to have high levels of collaboration between competing businesses. Competing businesses need to pool their resources. If you look, for example, at some of the traditional Asian businesses, the Japanese keiretsu, there is a high level of relationship between businesses. They pool some of their resources, and that enables them to much better take advantage of opportunities, upside hedging, and much better protect themselves against negative potential outcomes, downside hedging. So the focus at a business level is the relationship between businesses. And we tend to think of business to business relationships as either you're highly competitive or you're highly collaborative and it's a compromise line between them. Well, actually, those are better thought of as two complementary dimensions where you can be highly collaborative and highly competitive in your relationship with other businesses. And you can sit up here in that space of 60 to 80% collaborative and 60 to 80% competitive. Once you do that, it enables you to build strongly connected business systems. It enables you to invest in business systems that are strongly connected because there are strong relationships between the businesses, collaborative and competitive. And this, if I look then at human society, if you look at human societies around the world, they highly value relationships. And this gives you clarity from through one lens that a big reason why we value relationships is not because of an altruistic care for the other. When you look at the world as it really is, being in strong relationships with other people in your community, where you're sharing resources, where if one person gets sick, the rest of the community comes along and feeds them so that they regain their health and then maybe next year they need to feed somebody who's fallen sick. This valuing of relationships has a very strong rational driver in how the world really works. And this is what economists have got wrong. They think that relationships, collaboration needs to be explained with behavioral things like altruism or community bonding or something like that. Actually, the need for that explanation is significantly lower than we think once you include how randomness really works in the world. It's in our self-interest to collaborate. And yes, there's room for altruism and all of that, but in my opinion, it's not actually the primary driver. It's a secondary enhancement. It's the cherry on the top. The primary driver is the most effective strategy for individual success in a random world lies in high levels of collaboration. First of all, on the how they're tied. So at the moment, we've coded a relatively simple representation of randomness. So you can take, let's say, historical real world events or your best guess at to future real world events. What's interesting is the future. So all we can ever do is put in our best guesses for future real world events. And the levers that you can use at the moment is let's say, the base volatility, the randomness that you can predict will be happening on a month-to-month basis. That's in there. And then you can also put in extreme events. Now, you can use this in such a way where you take historical data and put in actual historical data and see what that does. The thing is that the most important thing for what we're looking at is predicting into the future. And so you have no idea what is actually going to happen month to month. What this shows you is that if you put in realistic forecasts of the kind of volatility that you can expect to have, what is the spread of outcomes that you might have from where you are now going forwards? In terms of decisions, there are a couple of key messages here. One of them is if you look at, say, a company's performance over the past 5 years up to now, you have absolutely no way of knowing with that single company whether that performance is dominated by good luck. The universe just happened to roll a bunch of sixes as the dice rolled. Or was it dominated by the average? Most people who are taking past performance of the company and using that to predict future performance are making the assumption that the performance up until now is more or less average of volatility. What we're showing makes it really clear that you basically can't make management decisions with the level of confidence that people are at the moment, or investment decisions with the level of confidence people are at the moment, based on the volatility that the company has actually experienced up to now, because you've no idea which universe you are actually operating in. For example, between 2012 and 2022, the top 20 IPOs in the US, none of them ever exceeded the share price on the first day of trading. Yeah, and that's an example of what we're talking about here. So the real message for leadership decisions is we need to be much less convinced that the data is actually really reliable and we can use that data as the only source of management decisions. what we need to do is run this kind of simulation to get an idea of just how sensitive our business is to randomness. What is the spread in that fan chart? And take business decisions where, at the very least, the middle of that fan chart is an outcome that we can live with, rather than the traditional business planning, which is so heavily dominated by the very rare high upside events. Not sure if that answers your question fully, but I hope so. Already built into the software there are two things built into the software where we can include at least some level of representation of these risks. And just as a side comment, everything that has been driving what we've been doing for the past 2 decades now is about how can we build business in a way that is fundamentally not going to recreate the poly crisis. So this question is really at the heart of everything we're doing. So yes, first of all, there's in the Swan events that you can build in, that represents some of the big things. Secondly, one of the other things that we've shown in this simulation and in other ones, this what you saw in there as the ergodic deficit or the volatility tax, in other words, the gap between what is likely to happen and the prediction of business planning or portfolio theory, a big driver for pushing things into externalities is closing that gap. Businesses promise to investors a certain performance, a certain return, but their most likely performance is significantly below that. And the only way that they have of closing that gap is by screwing down wages, screwing down the payments to suppliers, screwing up prices, pushing costs out into society, out into nature, etc., etc. So inside this is a very, very clear line of sight of a big driver of externalities. And the other thing that's built into the software is what's missing in most business planning is resource constraints, tax constraints, and things like that. So there's a factor in here built in, which it takes a little bit of sensitivity and understanding of how it works to set it correctly. But we call it an econophysics or a friction setting, and is basically building in the upper level constraints. If you think of donut economics, it's building in a factor for the resource limitations. And again, makes very visible that normal business planning just doesn't do the job we need it to do, because normal business planning just does not include these constraints in any way whatsoever. Hope that addressed your question.
I'm muted. Yeah, absolutely. Happy to wrap it up. That this is an awesome conversation. So yeah, certainly not trying to cut anything short. But I actually think this addresses perhaps some of the questions I saw in the chat, just in terms of what's next and how we're able to stay in touch and collaborate with interested folks on this call. So Graham has gone through such an amazing set of explorations, and I just appreciate all of the discourse that's followed. So we've ultimately made it easy to start at whatever level makes sense for you as you continue on your own journey. So you can start by following us on YouTube and LinkedIn, or reading the Ergodic Investor and Entrepreneur book that Graham has so graciously written. We're also planning a 3-part webinar series, so please reach out to us if that's something that is of interest to you. And then some of our deeper work is around a guided cohort that puts you in a small group of founders working through the same challenges where you'll be led through expert facilitation and direct access to the modeling tool. And then, of course, deep diving one-on-one with the experts here at Evolute 6, so Graham, Marie, and Julia, working very closely and directly with you. And yeah, thank you. I learned both from Graham and everyone else who spoke today. So thanks so much for the time.
Thank you,
Wonderful.
Nikki. Thank you,
Thank you,
Graham.
Nikki.
Thank you all.
Thanks all.